Welcome back to the deep dive. Today we are tackling something absolutely fundamental. We're unlocking the balance sheet. And this isn't like the income statement, which tells a story over a whole year. This is different.
It's a snapshot, a single crucial picture of a company's financial health, what it owns, what it owes, at one precise moment in time.
Exactly.
So our goal today for you is to really master three things. First, the basic equation that holds it all together. Second, the key ways things are classified, which tells you all about risk. And third, the surprising ways it looks different around the world.
And to get us started, I love the historical parallel our sources brought up. Think of the balance sheet like a modern doomsday book.
From the 11th century. William the Conqueror.
Right. The complete reckoning of everything a kingdom, or in this case a company, owns and owes on one specific day. It's that comprehensive.
And that entire reckoning, that whole structure, rests on one single unbreakable rule, the accounting equation.
Assets, liabilities, plus owner's equity.
Always. It has to. When you boil it all down, assets are just the resources the company uses. The cash, the factories, the inventory.
And the other side.
Liabilities and equity are simply where the money came from to get those resources. Creditors funded the liabilities part, and the owners funded the equity part. They have to balance. They just have to.
Okay, let's unpack this. If we start on the own side of that equation, assets, this is really where the idea of liquidity starts to take shape. We have to immediately draw a line between current assets, the stuff that moves fast, and long-term assets, which are, the big permanent investments.
That time horizon is everything. Current assets are anything you expect to turn into cash or just use up within 1 year. Or technically one operating cycle, but a year is a good rule of thumb.
And why is that distinction so important?
Because it's all about a company's ability to stay alive day to day. Can it pay its bills right now? The answer is in the current assets.
Everyone starts with cash, of course. But what's interesting is that huge companies don't just have cash sitting in a checking account.
No, not at all. They have what are called cash equivalents, basically very safe short-term investments.
Yeah.
Like Microsoft had something like $63 billion, and most of that was actually in short-term Treasury bills.
Wow.
Next up is accounts receivable. That's money customers owe you because they bought something on credit.
But the number you see on the balance sheet isn't the full amount they owe, right?
Right. And this is a key point for you to understand. It's reported net of an allowance for uncollectible accounts. It's basically management's best guess of how much of that money they'll never actually collect.
A little bit of judgment baked right into the numbers.
A huge piece of judgment, yeah.
And sometimes a company just can't wait to collect that cash. I'm thinking of the Sears example. They needed money fast.
That was a classic case. They just sold off their entire credit card loan portfolio. Their receivables plunged from over $30 billion down to $2 billion. It was a massive move for immediate liquidity.
A fire sale, almost.
In a way. And then you've got inventory. Simple concept goods waiting to be sold. But the scale can be mind-boggling. Walmart, for example, had $43.8 billion tied up in inventory.
And lastly, in this section, we have something called prepaid expenses. This one feels a little counterintuitive. How is an expense an asset?
That's a great question. Think of it like this. You pay your office rent a year in advance. You've spent the cash, yes, but you now control a resource, the right to use that office for a year.
So you've conserved future cash. You don't have to pay rent for the next 12 months.
Exactly. IBM reported $4 billion in prepaids. It's an asset because it's a future economic benefit you already paid for.
Okay, so that's the short-term stuff. Now we make that big shift to long-term assets, the foundation.
Right. The resource is held for ongoing use, not for a quick sale. And the big one here is property, plant, and equipment, PP&E.
The factories, the machines, the buildings. And this is where we hit our first really important contra account. You have to understand this one. It's called accumulated depreciation.
People get so tripped up on this, but the idea is actually pretty simple. It's about transparency. The company reports PP&E at what it originally cost to buy it, its historical cost.
But that's not what it's worth now.
No. And accumulated depreciation is the account that bridges that gap. It shows how much of that original cost has already been written off as an expense on the income statement over the years.
So it's not trying to guess the market value of an old factory.
Not at all. It's just a systematic way of matching the asset's cost to the revenues it helps generate over its life. The ExxonMobil example was perfect. $409 billion in original cost, but $182 billion in accumulated depreciation against it.
So that contra account is key. It shows you the remaining unexpired costs.
Precisely. Now, moving away from physical things, we get to intangible assets, patents, trademarks, and this big fuzzy one called goodwill.
And the rule here is critical. You can only record an intangible asset if you bought it.
Yes. You can spend 50 years and $1 billion building the most powerful brand in the world, but if you did it yourself, its value is zero on your balance sheet.
The Alltree example nails this. They reported $17.3 billion in intangibles, mostly goodwill from buying other companies.
But the value of their own Marlboro brand, arguably one of the most valuable brands ever created.
Nowhere to be found,
Yeah.
because they didn't buy it from someone else.
And this brings us to goodwill specifically. It's a really risky asset to have on the books
Why is that?
because it has to be tested for impairment every single year. You have to ask, is the business I bought still worth what I paid for it? If the answer is no, you have to write it down.
And that write-down is a huge expense that just wallops the income statement.
It absolutely crushes it. So a bad acquisition from 10 years ago can suddenly come back to bite you and destroy this year's profitability. It's a direct link between past strategic mistakes and present-day pain.
Okay. So that's the asset side, what we own.
Now, for the other side, if assets are the resources, liabilities and equity tell us who paid for them. And the classification here, current versus long-term, is all about who gets paid back first.
Right. Liabilities are what you owe to creditors. Let's start with current liabilities, the bills due within a year.
This is your accounts payable to suppliers, your short-term debt, and also these things called accrued liability.
Which are what exactly?
Expenses you've incurred but just haven't paid yet. Think employee wages for the last week of the year or interest on a loan. Walmart, being this massive operation, had almost $19 billion in accrued liabilities.
And there's another odd one here. Unearned revenue. How can revenue be a liability?
Yeah, think about a magazine subscription. You pay for a whole year up front. The magazine company has your cash, but they haven't delivered the magazines yet. They owe you a service.
So it's an obligation, a liability, like those old Sears service contracts.
Exactly. They owe the service. Now, shifting to long-term liabilities, these are obligations due more than a year from now. This is where you see a company's real financing structure.
Like AT&T, which relied on long-term debt. $66 billion worth.
But it's not all just straightforward borrowing. We have to talk about deferred income tax liabilities, DITLs. AT&T had $43 billion of these.
This one sounds complicated.
It's just a timing difference. Companies often use different accounting rules for their shareholder reports than for their tax filings. For tax purposes, they might depreciate a new machine really fast to get a bigger tax deduction now.
But for their shareholder report, they use a slower, straight-line method.
Right. That difference creates a tax bill that they will have to pay eventually. It's a real liability, just one that's been pushed out into the future.
A debt to the government that's been delayed. Okay, I get it. And then there are these massive obligations for things like pensions. GM had a $114 billion pension obligation.
Staggering. And here's the strategic question for you to think about. That money won't be paid out for decades, maybe. So why does seeing that huge number on the balance sheet today matter so much to an investor?
I guess. Because even though the cash isn't due tomorrow, that money is already spoken for. It tells you how much of the company's future cash flow is already committed.
You've got it. It reduces future flexibility. It makes it harder to borrow money today because lenders see this giant, inflexible claim on future resources. It shows long-term strain.
So we've covered liabilities. What's left is stockholders' equity.
The owner's slice of the pie. It's the residual claim, the buffer that protects all the creditors.
It starts with common stock and additional paid-in capital. That's the money shareholders put in directly when they bought the stock.
But that's often the smallest part. The real engine of the equity section, the real story of value creation, is in retained earnings.
Which is the sum of all the net income the company has ever earned.
Minus all the dividends it has ever paid out. It's the profit that has been reinvested back into the business.
The Coca-Cola example here is just incredible. They had about $13 billion in direct stock investment from shareholders. But their retained earnings, $58 billion.
It completely dwarfs the initial investment. It shows the immense power of compounding growth by profitably reinvesting your own earnings year after year.
And this brings us to our second big contra account, this time on the equity side. Treasury stock.
Right. So a company has two main ways to return cash to its shareholders. It can pay a dividend or it can buy back its own stock.
And when it buys back its own stock, that's called a share buyback.
Yes, and the cost of buying back those shares is recorded in this treasury stock account. It's a subtraction from total equity. It reduces the owner's claim because the company has effectively given some of that capital back.
So it's a signal from management about what they think of the stock price.
It certainly can be. And we should also give a quick mention to something called accumulated other comprehensive income, or AOCI.
Right, the sources called it a kind of catch-all.
It is. It's for weird equity changes that, for complicated accounting reasons, don't flow through the income statement. Things like changes in the value of certain investments or adjustments from foreign currency exchange rates. It just ensures that the balance sheet always balances.
Okay, so this is where it gets really interesting for me. We've defined all the parts, but why? Why is this structure so rigid? Why the obsession with splitting everything into current and long-term?
Liquidity. It's all about assessing the company's ability to meet its short-term obligations. It comes back to that operating cycle we talked about.
The flow of cash to inventory.
Inventory to receivables, and receivables back to cash. Current assets are the fuel for that cycle.
And the U.S. balance sheet is literally structured to highlight that. We list assets in order of liquidity. Cash is first, then accounts receivable, then inventory. PP&E is way down at the bottom.
A creditor can glance at it and immediately get a sense of how quickly the company could raise cash if it had to.
And the balance sheet doesn't live in a vacuum. It connects or articulates with the other financial statements.
That's the first huge connection. Net income, the bottom line of the income statement, flows directly into retained earnings on the balance sheet after you subtract out any dividends.
So a company earns $10 million, pays out $2 million in dividends.
Its retained earnings goes up by $8 million. The statements are fundamentally linked over time.
And the second link
Is with the statement of cash flows. The balance sheet gives you the cash balance on December 31st, a static number. The statement of cash flows is the movie that shows you exactly how you got from the cash balance on January 1st to that ending number.
which leads to a really important question. Does the balance sheet look like this everywhere? Is this liquidity-first structure a global standard?
No, not at all. It's actually very U.S.-centric. The core equation, A equals L plus E, is universal. But the presentation, the format, can be radically different under international standards, IFRS.
Okay, so in the U.S., we typically use what's called a report form, a vertical list.
Yeah.
It's always comparative, right? You see 2023 right next to 2022.
Always. You need that comparison to spot trends. But outside the U.S., you find a format that emphasizes a totally different strategic idea. It's not about immediate liquidity, it's about structural permanence.
How does that actually look? What's different?
Two big things. First, they often flip the whole thing upside down. They list long-term assets like PP&E first.
So the least liquid assets come first.
Exactly. A total reversal. But the second and more profound difference is that they explicitly calculate something called net current assets, or working capital, right on the face of the statement.
So they take current assets and subtract current liabilities to get one number.
One single critical number. And there's a deep business logic to doing this.
Which is?
This format is designed to show you how much long-term financing the business actually needs to survive. Of course, you need permanent capital to pay for your long-term assets, your factories, that's obvious. But you also need a permanent chunk of capital to fund your day-to-day operations, your working capital. That buffer of inventory and receivables over your payables isn't temporary. It's a constant ongoing investment.
Ah, I see. So under that international format, the big equation becomes total long-term financing needed is equal to your long-term assets plus your working capital.
You got it. It shifts the entire focus away from can we pay tomorrow's bills to is our entire operational structure financed with stable long-term capital?
It's a completely different question.
But different strategic concern entirely. The U.S. form asks about survival. The non-U.S. form asks about stability.
So wrapping this all up, what does this mean for you, the listener? We've seen that the balance sheet is this dynamic snapshot held together by that core equation. We know the difference between a resource and where its funding came from. And we've seen how contra accounts like accumulated depreciation give us a clearer, more transparent picture.
And here's the final thought we want to leave you with. The next time you look at a company's balance sheet, don't just read the numbers. Look at the form. Ask yourself, is this presentation screaming liquidity like the U.S. model? Or is it emphasizing the structural permanence of its capital, like that global working capital approach? Just the way the information is organized can tell you so much about management's strategic priorities.
Absolutely. The form itself tells a story. And on that note, go look up a company's retained earnings for the last 2 years. The change between those two dates is where the story of profit and reinvestment truly comes to life.